Hello, and welcome to this week's PennEnergy News Update. I'm Hilton Price. Sanctions against Iran and lower Saudi output are being blamed for a drop in oil production in June from the members of OPEC. This, according to the U.S. Energy Information Administration. OPEC countries produced an average of 30.5 million barrels of oil per day last month, a 1.2% decline compared with the previous month. Production in Saudi Arabia dropped to 9.7 million barrels per day in June, compared with 9.8 million barrels per day in May. Iran's oil exports, which have been curtailed by international sanctions over the country's decision to move forward with its nuclear program, dropped to 2.9 million barrels per day in June, compared with 3.13 million the month before. The Chinese government announced this week that it intends to dramatically increase support for electric and hybrid vehicles, with the goal of selling as many as 5 million of the vehicles by the end of the decade. The plan stems at least in part from efforts to control the effect of oil prices on the country's economy. The country's growing middle class, combined with rapid urbanization, have led to a sharp increase in demand for motor vehicles and the gasoline to fuel them. China is the second largest consumer of oil in the world, behind only the U.S., but domestic production falls well short of demand, making it also the second largest importer of crude oil, again behind the U.S. The Norwegian government has taken a drastic last-minute step to end an oil industry labor strike and avoid any interruption in oil production. The Norwegian labor minister forced the ongoing labor dispute into arbitration on Monday, just half an hour before the country's oil companies plan to lock out offshore oil rig workers. Norway is the largest producer of oil in Western Europe, but the Scandinavian nation had already seen oil output decline by 15% as companies prepared for an orderly shutdown. The current strike among oil workers is the first in Norway since 2004 to cover the entire industry and has already cost the country around $440 million in lost production and tax revenue in the past 15 days. After months of rock-bottom prices spurred by massive oversupply, the natural gas market has begun to revert to a more normal price pattern. For the first time in 10 months, natural gas prices have moved into what is known as normal backwardation, when contracts for further in the future trade at prices below those that deliver earlier. It can also mean that future contracts are trading above the spot market. This represents a welcome change for natural gas producers that saw the price of the hydrocarbon fall to a decade low earlier in the year on the back of rising production from hydraulic fracturing combined with a mild winter. However, it does not necessarily represent a shift in the overall market. Officials in Pike County, Mississippi are looking to open new areas in southwest parts of the state to oil exploration. The Tuscaloosa Marine Shale Formation has the potential to be a major source of oil and gas, and development of the site could lead to a major increase in business. Several industries would benefit from such a project, as there would be a surge in oil workers with newly available disposable income. One official in the area says several counties in the area would benefit from increased production, and that these counties should work together to ask the state to increase its share of severance taxes. Currently, counties receive about 15 to 30% of the tax, which is based on money paid on oil and minerals that are taken from the ground. Thank you for joining us this week. For these stories and many more, go to PennEnergy.com.